Hello, Nasa, Hassan?
Yes.
Okay, so
Yes, sir.
you guys just saw the link, the Zoom link, right?
Oh, yes, yes.
Oh yeah,
We
yeah.
just,
Yeah, I just posted it immediately, so I hopefully we are on the same page, right? So
uh,
okay, no, but just take a 1 minute. Let me prepare the everything. Um, okay, good evening, everybody. I think most of them are there, and so let me firstly discuss the um, let me see if I need to discuss the homework or say some materials. Okay, let's look at the homework a little bit here. Um, hmm, I need to find out where's the homework there. Okay, so let's start from the homework part. Okay, so the last week I just recently graded all the homework and I found there's several problems. The one thing is that let's look the fundamentals in some mathematical methods. Those two problems are based on some examples in the oral lecture, and you need to find out a little bit. There's some small area in the PDF files, I believe, some similar examples. Okay. Um, the first one basically required to understanding very important concepts in terms of the returns, because in finance, probably the only variables we care about is returns, right? Portfolio returns, security return, stock returns, bond yield. There's a different word like a yield, right? Or some from a corporate finance perspective, people call them a cost of the capital, right? Cost of the debt, cost of the equity. In finance, they're equivalent to the stock market returns. Okay, so since the return is so important, we're talking about two concepts. One is that the log returns, the other is the simple returns. So the simple returns just simply, for example, if I tell you the price, the security price between any 2 days, right? And you want to figure out what's going to be returned, just calculate the percentage increase for the price. And you just multiply multiple periods to get the simple return during this multiple periods. That's general idea. But if I take the log of the returns, the only benefits is that I don't need to multiply to each other. I just simply sum over each other. It looks like simpler in terms of mathematics. And more importantly, when I take the log, the results usually change not very much. For example, like 4%, if you take the log, it's kind of like a 4.01 something, it's not much differences. So this is the background, right? And this question give you, like, for example, there's a 5 days returns, right? So the corresponding daily log returns and what is a weekly simple return of the stock. So note that this is all the simple returns, right? So probably you need to, if you calculate the simple return over the entire period, you just simply multiply to each other's, right? For example, the first day, 1 minus 0.4% times 1 plus 0.8%, and so on, right? Get simple returns. And the daily log returns, you just simply take the log on each day and then sum together, right? So that's just the idea is that I have posted the solutions there. I hopefully you can go through by your own selves. The second question is to talk about if I give you the regression. This is a autoregressive with one order one AR models, right? I tell you the constant, I tell you the coefficients, and anybody can tell me it is a stationary or non-stationary process based on this equation. You want to keep a look at this coefficients, right? If you still remember, because the coefficients equal to 1, that is the unstationary or unit root. Okay, because if you go back to our the properties of AR1 model, particularly AR1, because it's relatively easy to derive, you will find that you need to satisfy the coefficients strictly less than 1 and larger than 0. I don't think this not necessarily larger than 0, but you need to less than 1 to make sure the expected value is in some reasonable levels, right? It's converged. So in this case, it's if it is equals 1, it's unstationary. It is also understandable from economic intuition because that means your next period performance will be simply cumulative of previous plus some random numbers. So that means it's totally unpredictable, right? Unpredictable. For example, if I want to predict t plus 1, t plus 2, t plus 3, I mean multiple periods ahead, you will find that if it is a coefficient equals 1, and the expression that the future day's performance will kind of the multiple impacts of a previous days, and the more days data, the larger the impacts of past histories. So it's basically explosionary, and we can make exercise predictions. So in this case, we need to make sure less than 1, right? Less than 1. So that makes the past impacts as small as possible as of today's, right? That means that the longer the period is far away from today, the less impacts, right? If it were this case, you can think about this. You can write down by on yourself. I think that just limited by the Zoom interface. It's a little bit hard, but you can write down by your own self. For example, if I require you to write RT plus 1 equals what? So RT equals 1, we're going to be this constant 0.003 plus RT, right? Because you replace T with T plus 1 every submonodes. So T and AT plus 1. And also we know that RT also equals to 0.03 plus T minus 1. So you can see the past impact is kind of finally it becomes RT plus multiple periods will be simply sum over past histories, sum over. So the longer the history, the more impacts. It's not what we want to do. What we need to do is that the longer the histories, the impacts will be lower. So you can imagine that this coefficient is better to be less than 1 to make the system stabilized, right? Okay, so AT is kind of a shock, which is happens today, and you never know that. Before today, you will never know what's going to happen today for the information shock. And this shock we assume is kind of white noise. That means they are stationary with mean zeros and the volatility, constant volatilities. That is the stationary process in terms of the residual sense. Note that this is a 0.25. This is a constant. This is not a function of time. If this volatility is a function of time, it is not good. That means your residual is unstationary, right? So this is what we need to do. Okay, so and we know the 100 time when t equals 100 equal these numbers, 95 interval forecast for 101, and at the forecast origin t equals 100. That means we're basically standing from the timing of the t equals 100, make a forecast of 101, right? And 95% intervals basically means that if you know the normal distributions, it's kind of 2 times sigma standard deviations, right? You will know that range will be the confidential interval 95%. I also give the solutions. If you have any difficulty understanding, for example, what I mean by interval, 95 interval forecast, what does it really means, that you better want to contact me, right, to recover the knowledge in these periods. Okay, and for the third questions, I'm just simply give you a couple of data, right? And you just look into some columns of the data, and you want to read into data to the computer system, particularly RStudio. You need to first to specify the path, the saving paths of these files, and using very simple command to look into those, to summarize those statistical variables, right? And sorry, let me. So the third question, we're talking about the yes, this one, right? Give the data file, and so this is a large data file, right? 1961 to 2011. Usually when we look into the financial markets, we're starting from 1961 because 1961 is the year that New York Stock Exchange, AMXE, and NASDAQ, both of them has data available. So I think NYSE has the largest data because of the longest history. NASDAQ is not until 1961, right? So this thing. And so the key part is that you need to read into the data to the computer, right? The second thing is to test the null hypothesis that the first 12 lags of autocorrelation are 0 at the 5%. So first 12 lags, that means you want to look into the lag 0, 1, 2, 3 to 12, right? You want to make sure they're not equal to 0 or not, right? You want to test hypothesis. You want to first look at the ACF, autocorrelation functions graph, and then you perform the chi-square test, and usually they will give you the p-values, right? And that test we call them Box-Jenkins. You just follow that part, or lectureship or textbook. I believe they're definitely there are simple examples, right? If you couldn't find them, or if you really feel really difficult to understand the solutions uploaded, you can just let me know. Okay, so sometimes when we go through the knowledge, we maybe forgot where are we in the knowledge system. I think that's the very common things in such a class, right? I try to mitigate the quantitative properties of the class. That's only my best. Unfortunately, most of the time we can't avoid them. So although I've tried a minimum exposure on that, right? Okay, so this is assignment 1. Okay. Any questions?
Professor.
Correct. Yes.
I mean, I don't know if we'll have time, but would we be able to run through that question 3 if it's possible? Like, would you be able to show us in RStudio how you got the answers?
Oh, you want me to show demonstrate from step zeros? Okay.
Yeah, I mean, if you can. If you can't, it's fine. I understand.
I understand. Unfortunately, I didn't prepare to do so to set up today, But let me say what we need here. What I can best try, because I want to start from the new materials today, but I want to leave some time at the end if you have a, let me say, okay, let me find out the course materials. Assignment 1 solutions. Let me see what kind of solution I provide to you. Okay. Okay, so you know what? Okay, so since you mentioned that the file for the number for the third question, just mention a little bit here, because I'll try. Okay, so for example, the first line, right, to set your path for saving this file, the data files, and then you install the package fbasics. I believe if you follow my previous week's exercise and the files, you should have already installed that, and you call this, right, this output, and this next line you read into the data, and you only look into the file, the column -L2 and -L10, and then rename that, and just perform the basic statistical summaries. That's the idea, right? Right, Austin, right?
Yep.
Yeah. So do you want me to demonstrate here in the RStudio? I can do so. If you can do it by yourself.
I think I got it. I think I got it.
Okay, perfect.
Yeah.
So in that case, I will start from the new things today, right? At the end of the class, if you have questions, we can discuss at that time, okay?
Sure.
Okay, perfect. Thank you very much. And so let me go to our TBO case studies. Okay, so today I'm gonna talk about the cases. Sorry. So today I'm gonna talk about a cases I download from our textbook, which is a mini case about the time series estimation for the asset price model. I believe it is very relevant to the future job, and as well as the most recent news in the financial markets. Okay, so this is really a comprehensive work. I don't feel it is very difficult. I just feel it's very straightforward. But it gives you some idea how our time series, the model we have trained so far, can be applied to the real world data analysis. So, however, before that, I want to mention a type of model. It's so-called the market model. And let me put out a PPT slides, which I taught in other classes. And let me briefly introduce several pages of that. And then we go back to this mini case. Okay, I believe some of us already have exposure on that, but just I want to make sure we're all understanding on the same page. So I just want to talk a little bit here. Let me go to, okay, so, give me a second. Okay, let me show you something here. In finance, when people look into, if I want to look into a type of model, okay, our task or our target is trying to predict the returns for some specific stock. We understand it is very challenging because stock market by itself is highly efficient. That means that usually you can't get any inside information or just purely analyze the past trending issues to forecast the future. Sometimes it's a futile, that it's very difficult. The reason is that there's just so many people on the stock market to look into analyze, to look into the research. So that means you alone, if you find any precious information you use for the future forecastings, every people can do the same. So let's think about this. You look into the Apple stock, right? And you find that, okay, there's something Apple stock in the past history, very interesting, and you believe such abnormal returns will be happen again somewhere in the future. So you begin to buy a lot of Apple stock. And the usually such techniques has been explored by so many competitive financial analysts. So every people will do the similar work. So that means all of people will buy the Apple stock simultaneously. And then the outcome will be the Apple stock price will goes up because the huge demand, right? When the price goes up, what happens? Your returns will be lower or even negative because the chances likelihood is very higher. The stock price will goes down, right? So that's become overpriced. So that means on the equilibrium, where the demand and supply is stationary, the you can't find any free lunch from the financial markets basically. Okay, now it is choose. So that is no wonder nowadays a lot of people when they make investment, they are only looking to the passive investment strategies. That means I only investment in the market index like S&P 500 or Nasdaq, those market average, because we know that market average will be usually increased, although with volatilities in the past decades if you're holding this for a long time, right? Rather than looking into the specific stock, right? So under this background, you'll find that there's a type of model so-called a single index stock markets. Okay, so that means if I want to look into specific company stock returns, I want to look into model that, right? I want to predict that the returns. Then it'll be function of market returns plus some constants plus the arrows. So that is the so-called single index stock markets models. Okay. RM represents the market portfolio. You can think about S&P 500. So this model basically assumes that I assume each individual stock only relevant to the market by entirely, not to other factors. Okay, and the beta, which is the coefficients, what represents the association between your individual stock with the entire market. Okay, and alpha, what is the alpha means? Okay, the alpha means that, for example, even the market is zero, mathematically, I think the mathematical explanation will be easier to understand. If the market return equals zero, the alpha is still there. That means alpha represents your single stock returns over the market average. If you have alpha, definitely it's good news, right? And this is arrows, right? Because the model definitely some arrows. Okay, so this is a so-called single index stock markets models, all right? And sometimes we call them a CAPM, the capital asset price model, which is developed since 1960s. Nowadays, a lot of people came across with other new fancy models. For example, put other factors like GDP, oil price, you can name a few, right? But some factors were finally insignificant, and some of them are significant. And the people find that usually the market index as a whole will give you a significant result. That means the coefficients is significant, right? So indeed, it can have some predicting power for this specific returns, right? For the specific stock or company, right? So that is the background by the single index stock market models, okay? And I think, let me see if I need to introduce more. Okay. Okay, I think that's all. Okay, that I just look into the empirical or the data-driven explanation on that, because actually this model is derived from the theoretical portfolio theories, but I will not focus on that. Okay, because we have different backgrounds. Some students may already have learned that, and sometimes you may have not, right? But you just look into that, this format we're looking into. Okay. Um, Now, let's go to the real model of this class. Okay. So in this application, okay, so let's look what the target of this work. So this work was looking into two time series, right? Two time series. For example, they introduced the model very briefly, right? So this is y alpha beta x plus this arrow. You can see this model is exactly very similar to what we have mentioned before, right? We call them a single index market models. So this project is interested in the term structure, right? The term structure. I think you require some readings when I introduce the model, so you can try your best to read that to get some ideas. I will go through very slowly. Okay, so the term structure of interest rates is another example in which the time evolution of the relationship between interest rate with different maturity is investigated. So this work, today's class, we will look into predicting on the term structure of interest rate. Okay, I assume we have some background, but I just briefly introduce why we need term structure, what is term structure, and what the meaning of that, right? So let's say uh, let's say what let's Google this a little bit. Let's look at the today's news. I think. Let me. Okay, how about let's show this, right? The term structures, right? This is usually the term structure, what it looks like. So this is time to maturity, and this is the yield for a bond. Usually, for example, if you look the bond returns, right? Like say the government bond, 10-year treasury bond, a 1-year treasury bill, or 30 years treasury bond, so which is issued by the US government, okay? And we understand the longer the time to maturity, the larger the yield you will expect to get. The reason is that the longer the maturity, the bond, there's more riskiness, right? What kind of riskiness we have for the government bond? Can you name a few for me? The time to maturity, right, represents the longer the period, of course, you will be exposed to uncertain inflation, right? For example, you're holding a 30 years government bond. When they pay you back, and after 30 years, definitely the inflation has been multiple times. So in this case, you need to make sure your return will be compensated by the inflation. And we know if you read the recent news that the U.S. long-term, that means 10-year government bond yield has been 1.6%. It is actually quite low. It is so low, to my surprise. The reason is that if I'm holding a 10 years bond, definitely the inflation in the US is very high. Even, I mean, 2, 3% or 4, multiplicative compounding 10 times is very high. I don't understand why they only have a 1.6, probably because the precautionary, people looking for the safe assets. But anyway, so the longer maturities, the larger the yield, right? It's understandable. This is normal, right? Because more higher riskiness, or maybe government maybe default. And sometimes it is inverted. The longer time to maturity, the lower the yield. What kind of situation we can have? Why the longer the maturity, the lower the returns? Usually that's because people are very pessimistic about the future economic situation for the US, for example, right? Because this is normal. This is normal, right? The longer the period, the holding period, the larger the inflation, right? It will be higher. If you neglect the default chances, the only risk probably left will be the inflations. However, there's one where people assume that after 10 years, the inflation is very, very low or even negative. What does it mean? That means there is a depression on the economy, right? When the economy is in depression, the inflation goes lower. You can see the recent days news, right? The economy, people expect the economy will go to the back. So if the inflation expectation goes up, right? So this is the one things. And this is flat. So this is a different shape. So this is so-called the term structure, right? Now let's look into this work we're gonna do. So this work we're gonna do look into using some factors to predict what's gonna be the term structure or the interest rate, the relationship between the yield and the time to maturity. This one is very important things, right? Because we know that every financial assets, their pricing is based upon the basic interest rate, right? Bond valuation, stock valuation, the derivative, even the mortgage, right? So this is a very useful work. And we know that recently the mortgage in the rates is very volatile, right? You probably have some incentives say, hey, I want to predict a little bit on the mortgage rate, right? So that's very useful. In this regression, usually y and x are two time series, and e denotes the error terms, right? All of them are time series, right? The x obviously is kind of a very important economic factors, and I want to use that to predict what's going to be the yield in the future yield, okay? And we were going to use the least square method, least square. That means I want to make sure the model estimated value as well as the real value of the deviation is as minimum as possible, right? That's the least square. Yeah, so this model is very interesting here because if you remember, the previous class is a little different from the model we introduced previous class, right? Previous class we have introduced the one is AR model. That means the YT, it is on self. YT minus 1, YT minus 2, for example. Or the YT is kind of moving average, is this a function of AT plus 1, minus 1, sorry, the residuals. So here is kind of, I use the different variables. Why we do this? Why we not, for example, why not use the AR model, simply like YT equals function of YT minus 1? The reason is that those yields, when we establish model, I'm not only forecasting, but I want to understand what kind of factors impact that. And that is especially useful for the policymakers. Okay, so if you use autoregression models, think about this. If you use only autoregression model, right, the future returns will depends on the past periods. But even you can get very precise, the very exact estimation of forecasting is good for you for forecasting. However, for the policymaker, for the government, it's useless for them, right? Because they want to make some policies simultaneously can be good for the or dependent variables we're interested into, right? We need to look into what kind of factors simultaneously can impact that, so we can work on this, right? This will be useful. I want to look into economic mechanism. So this is so-called regression, right? This is called a so-called regression model because we use different variables, right? So, however, when you estimate this model, you want to be careful of one thing. So care must be exercised, however, as not to overlook the theory of dependence in ET. That's very important thing. You probably have never think about this, right? So ET is the arrows. If the arrow is not good, the model definitely fails. So in what sense that I would say the arrow is not perform good? The reason is that I want to make sure the arrow is a white noise, it's random. If you look the plot the residue against the something, you will see the residue is kind of scattered, distributed, kind of irregular. It should be no clearly trend, right? So in this case, I want to make sure there's no serial correlations, right? For example, like 1 to like 10, there's autocorrelation should be zeros. That is good. So we need to be careful with about the arrows. Okay, so this models, the authors basically introduced the model by considering the relationship between two the US weekly interest series. So one is the 1-year Treasury constant maturity rate, and the second is 3-year Treasury constant maturity rate. Okay, so this model basically we want to estimate the relationship between 1-year Treasury rate and a 3-year Treasury rate. Okay, so just let me know when you have any questions, right? I may go stop, right? Okay, so now before we do this work, let me look into, if we have time, I will put the code in the R Studio, but I believe since all of the code has been here, you can do by your own self. If you have any difficulty, if we have time, we will demonstrate that, right? But before that, let's look at the data, right? Data exhibitions. So this one is a year, right? This year, this is time plus of the US weekly interest rate from 1962 to 2009, right? The solid line represents the Treasury 1-year constant rate, solid lines, and the dotted line represents 3 years. Okay, so what you can find here. You will find that usually the 3 years yield will be higher than the 1 yield. Is that possible? I think it's a little bit difficult to check, but indeed, let me see. Dash line represents the 3 years. Yeah, you can see the dash lines here, right? Dash line is always higher than the solid lines, right? See dash lines, solid lines, dash lines, solid lines, right? Dash lines, solid lines. So dash line is always above the solid line, which is consistent with our expectation because the 3 years, people will have a higher expectation on the inflation side. Okay, now, can you answer me this question? Do you think this graph tells us that the 3 years interest rate closely related to the 1-year interest rate? That means if I know the 1-year or 3-year interest rate, I can predict the other one. Do you think so? Do you think we can?
Yeah.
So at a first glance, we basically see that they are moved in tandem. It looks like very much exactly the same shape, right? However, can we say if I use the one of them to predict the other ones, or their relationship or association is very significant, we need to look into the regression. Although it looks like the picture tells, yes, indeed, they should be closely related. And then let's just find out if it were the case. Okay, so this is 2 variables we're looking into, right? So basically, you look at to the data and downloads 2 files. You can see this is very simple regressions. Okay, simple regression. This is actually a cross-section data. Let me tell you what is the cross-section data. In the time series, it's very lengthy, from 1962 to 2009 on the daily basis. So there's going to be 22,467 observations. Again, this is not a big data. A big data is that every day we should have another tens of thousands of observations, because those financial instruments will be traded any second, right? So usually the exchange platform, the financial markets has the data tape by including all of the second level data there. So that's kind of a big data. But here I think it's really small. Okay, so 2,467 days, right? And okay, that's on the time series. Another dimension is the cross sections. That means 1 year, 3 years. So we have two different variables, right, on the cross sections. So you can name other field like a GDP, oil price, housing price, whatever, right? Okay, so this data is interesting. So you will see that the time series is much longer than the cross section. In the cross sections, you only have two variables. But on the time series, you have over 2,000 observations. So in this case, we basically assume this model is kind of behaves similar to the time series model. Sometimes there's other types of the model. That means the variables in the cross sections is much larger than time series. Okay, so it's highly possible. For example, if I have a data of a company, and I have a lot of variables. The variables could be the say different companies, different accounting ratios, different revenues. However, on the time series, I only look into recent 2 years. So in that case, you can see the cross-section dimension is much larger than time series. That's another way to handle it. Okay, so that things is another case that we only have a very few in the cross sections, only two variables, but very lengthy and the time series. Okay, so I think this textbook directly give you the first models, right? They try to estimate a model is like this. So 3T is kind of a 3 years trend rates, right? 3-year trend rate. This is a 1-year trend rate, and they do this regressions. So another way to describe the relationship between the two interest rates is to use the simple models, right? Usually, the such model can give us initial thoughts on the relationship. Okay, and it let the R to do that. R will have a this regression, and they give the standard deviation is 0.523. This is again assume it's constant, right? Oh, okay.
Sorry, Professor. So in the graph that we just went over, you said that there is, based on the image, a relationship. Is it because of how close knit the graphs actually are?
You mean this figure, the figure
Yeah,
2.26?
Okay. Yeah,
Okay.
you said you can assume well, you can kind of, yeah, I guess assume a relationship because of based on this graph, but you would need to build a regression model to see if you can prove against it, right? But what in this graph is showing you that there's a relationship that they're so close together, the 3-year, 1 year?
Correct. So do you think so? That's kind of a question I want to start out to think about the model. So do you think they are closely?
I mean, I would assume so based on how much they kind of overlap one another, yes. But is that why it can be assumed?
Yes, that's one of the things. Sometimes is there's such a graph might be misleading. That's what I'm looking into. The reason is that if you look at this, both time series performs really similar trend, but we are not looking into on the time series, right? We want to look into cross sections. So if you look at this, like you said, sometimes the dotted line above that, but sometimes they're overlapping. Sometimes the dotted line is lower than that. So in that sense, their relationship actually is very ambiguous, right? So yeah, in this is we can't, we can't sure. Although
this
we
image
know,
is easier, yeah.
Yeah, it's not so easier. It's just so close, right? So we want to build a model, right? We will later on implement in the R Studio basically. So
yeah, okay.
So this is the model, right? I just forgot about whatever the procedure I implement. This is kind of a model, and this model we know the coefficients, right? And let me see, wait a second. So this model, let's look at the performance, right? This model, they regress this model, right? They get some regret this model, and let's look at the model performance. This model performance. Okay, before that, let's talk about this figure. This figure is show you the 1 year and the 3 years, their scatter plots. This is another plot. This plot is not from the model, but just from the raw data. It's a kind of technique I want to look into their correlation. I just simply plot per each the same day, right? For example, on the 1965 January 15th, for the same day, I plot the 1-year rate and a 3-year rate on the X and the Y axis. And what you can find, okay, it looks like very correlated, right? Very correlated. And this one is looking into the change. That means you look at the change on the 1-year rate and change on the 3-year rate. Again, so they are also correlated. So it looks like they are closely correlated, and we expect their coefficients should be significant to some extent, right? And let's do this regression. So this graph show the residuals from the first model we just discussed, right? First model. So how do you think at the time series? Do you think the residuals is correlated as time passed by? It's hard to say, definitely, right? It's hard to say. I would say I'm not so sure. I'm not so sure, but there's something interesting you want looking into. For example, there is always such a pattern iteratively appear. For example, like this several peaks and it goes down. Several peaks goes down. Several peaks goes down. Several peaks goes down. There's a replication of the similar shape every period. It sounds like there's some trend on the time series correlation, right? So then we plot the ACF autocorrelation for the residue of the model, and what you can find is the model is okay. After examining the residuals plot, we found that, especially the ACF graph, we found the model is severely problematic. The reason is that, look at this autocorrelation, it's so significant, right? One lag ACF, such a high levels, right? 2 and 3 days, the interest rate, they're correlated to the residuals. The arrows, the residuals, it's so theoretically dependent. That means our model cannot be cleanly, very clean way to explain the relationship, because there's still some trend in the residuals and we need to explore. And it's also highly possible that the data is quite unstationary. When it is unstationary in the time series we have mentioned before, that means your past histories impacts on the futures is very heavy, right? The more the history data you have, the more impact that they will have. So that it is causing the trend on the residuals is not decays very quick. It decays very, very slowly, right? For example, if you look the even 30 days correlation is still very significant. Remember, this is the 2 confidential intervals, right? Far beyond that, it's very significant. So we can find what? We can find the data is very unstationary. And remember what we can do? We can take the difference, right? We can take the first difference. So this is the case. So which is so-called, this is a unit root behavior, right? And also you will find that inverted yield curve, probably as you mentioned here, right? So the reason is that in some sense, this is not surprising, because the pattern of inverted yield curve did occur during the data span. By inverted yield curve, we mean the situation under which interest rates are inversely related to time or maturities. That means sometimes we know that usually the longer the time periods, that means the 3 years compared to 1 year, you should have a higher yield, right? Because people expect there will be more inflation riskiness. However, sometimes maybe inverted. That means people expect that after 3 years, the US economy will go through depression, recessions. When they go to a recession, of course, the inflation will be very low because price will go down, right? So in this case, people kind of are pessimistic. In this case, we call them inverted. So that means that their relationship to some extent is mixed. We can't see very clearly, right? And so we say that firstly, they're unstationary. So what we can do is that I want to take the first difference. I generate 2 new data, right? This new data is particularly take the difference for each time series. Okay. Now, in this trading the data, you will find that you might be cancel out the stationarity, because now the data should be stationary. Take the differences. However, I think you're lacking of one observation, right? Because for example, you want x2 minus x1, x3 minus 2, you will find that the first observation will be disappear, right? Will be disappear because you will use that to calculate the difference, first difference, right? Okay, and now the model will be looked a similar way, right? This is new 3 years differences, the new 1 year differences against the beta. Okay, now be careful with this. The authors want to try another new regression model, and this regression model, they don't think there is a coefficients, the constant, sorry, not coefficient, but the constants. You're probably wondering why. It's also possible. That means when the 1 year rate goes to 0, the 3 year goes to 0. Well, it probably does not make sense because the 3 years, there are always some riskiness overlap that. So there should be some constant, but we will try this one and then we'll extend the model by adding into another constant, right? Okay, so let's look this model right now. After I take the first difference, I take the regressions, and it's like this. Okay, so if you look this change, what you can find, there looks likely relatively stationary, right? The data. So the data looks like very stationary, and you can see the upper and the lower band is very clearly. Okay, and the authors estimate this model get the new ones. The 3 year rate, 0.792 rate plus the arrows, right? So this is the new models they estimate. Okay, and R square, I still not mention that. The R square here is 82.5%. I would like to say this number is very high, very, very high. 82.5% simply means that the variation in the 1 year rate can explain 82%, 5% variation in the 3 years. So, can we say the model is definitely good? No, we can't do so. The reason is that we still need to look into if there's a zero dependence in the arrow term. R squared, definitely the higher the better, but sometimes they give us the wrong informations. Okay. Now, once again, they check the autocorrelation. Now let's look at the new model's autocorrelation so far here. Right, this is our residuals plot, and we look like the residuals is kind of like very stationary, right? And then not so much correlations. Because as time passed by, the residuals kind of randomly fluctuate, right? No specific trend, and you will find that you can see the model predictability in the 1980s, the arrow term is pretty large, right? 1980, that's a crazy period for the US economy expansion, right? When I'm not sure, I forgot the president, I think the Jimmy Carter and Bush, right? The first Bush. So the US economy expansionaries. So, but the yield is crazy at that time because there's some oil crisis at that time. There's many events happens. Okay, so the autocorrelation, if you look at the autocorrelation, okay, there's still some concerns, all right, still some concerns. First one, for example, like the one, like one. The like one is still very significant, and the like two is still very significant. And look at this, there's some up and down, up and down, up and down. This is a kind of a signal that there's some business cycle. That means their relationship is kind of a circuloid around. And you will find that there's still some significant, the autocorrelation. So it really depends on authors. So strictly speaking, okay, you probably want, okay, any significant autocorrelation I need to add into. For example, in this model, I definitely need to include the 1 year lag autocorrelation, 2 year lag autocorrelation, and probably this is 7 or 8 periods lagged at x minus 8, for example. I want, okay, for example, x minus 20. Sometimes those periods you can neglect. You basically, because it's too far away, intuition tells we don't want to include in that, right? So sometimes you need to look into some both economic intuition and statistical science combined together to design models. right? So all in all, we only focus on the previous ones, right? So, but at least this mouse model is much better than previous ones. Okay, so now next ones. This model we have been introduced it, right? The first one, let's look at the second model we used. Say the 3 years, the differences equals to the some coefficients times the 1 year differences plus some arrows, right? So the author introduced another fancy models here. So this authors mentioned that because the residuals of the model are serially correlated, we have mentioned that autocorrelation, you always cannot avoid that. So how do we handle that? So how about we model that? So this, we shall identify a simple ARMA model for the residuals. From the sample ACF, the residuals shown on the figure 2.30, we specified MA model for the residuals. 2.30, which one is 2.30? This one, right, this one. So look, so as we have mentioned that the residuals, it's still some correlation, especially in the early period lags, right? So remember, ACF is a good indicator about order for the MA moving average. What will cut off as the orders that the ACF is significant. So in this case, we have mentioned that which one is the largest impact? Lag 1 and lag 2. So the author suggests like how about use the lag 1 to predict it, the residuals. So they express model like this. Previously, they used the regression model, but later on for the arrow term, they use a kind of a moving average models, right? Moving average shock. This is the coefficients, perverse shocks, right? We have introduced moving average before. We cut off only include t-1 because from the ACF, we see the first lag is the largest, right? I think the author just don't want to add the second period lags because it's relatively less significant, although it's still significant, but less impacts, right? Okay, so you can see we kind of entertain original model by applying another moving average to describe the residual terms movements, right? Okay, now we continue to use this model to estimate the data. The R will do that for us automatically. Okay. And estimating such model is very time tedious, right? So the author has mentioned that, right, several decades ago. But now it's very easy thanks to the computer software. So in the R after regression, they found that, okay, they include another models, right, to describe the residual movements. And you will find that the coefficients is nothing much changed. Previously, I think it's a 0.792, and now it's 0.94, right? And the residual terms equals to the daily shocks, right? The coefficients, and then this per state shock that we can see this is stationary because it's less than 1. Okay. And again, so they improved the R square a little bit, almost unchanged. Okay, so now there's a question here. This is a separate models, right? This is a separate model. That means year 3 differences, year 1 differences, and this is the residuals. So we need to want to recover this model to original ones. That means you can express that X and Y, right? Not necessarily the differences, but instead the levels, right? The level, the convert back to the interest rate. So in this case, it's not so hard because C3T just simply means that the differences, the first order differences, right? Y3T minus Y3T minus 1. And the C1T just simply means X1T minus X1T minus 1. So you can re-express that as original format, all right? Substitute into that. And you put the ET, this one, substitute into the ET in this equation. So now after development, you can develop this one. Okay, so the model shows that the 2 weekly interest rate, okay, I'm sorry, they use the frequency of the weekly data. That means even lower frequency. So sometimes it'd be interesting, you want to use dailies, right? The daily frequencies would be high frequency, maybe give you more information on that. Okay, so this is the full models, right? Look at this, x1t minus x1t minus 1. This is actually the first differences, right, for 1 year. Okay, so let's mention a little bit more on the reason why this model, the author considered the weekly interest rates. Why not the daily? You think about if it is a daily data, the data size will be much bigger because they use the weekly. Every week they only have a 1 interest rate. That becomes the daily is multiplied times 5 days trading, right? Usually the higher the frequency the data you use, there's a more serious correlation along time series because the momentum. For example, okay, if the interest rate yesterday is very high, I think the chances that today they all of a sudden goes down is very small. They more or less keep the similar range and then gradually decreases or increases, right? So that means there's a momentum, right? So in this case, if you use the daily returns or even higher frequency, that means less than daily, like a second level, the risk, you will see there's a serious correlations because every, these two close 2 time periods will be correlated to each others. However, if I use the weekly interest rate, I mean last week and this week, because the time lag expense is so large, that means it's less likely that they are correlated to each others, right? So that's why the weekly data sometimes has give you better performance. Okay, so let's look at how do we implement in our demonstrations here. Okay. Okay, so let's go through quickly and let's see if we can implement our studio. Okay, so I think I will stay here for a couple minutes. That's 5 minutes. Use the 5 minutes to recover some readings previously, or even a little bit longer, like 6 minutes. I'd like you to read through that, go through model in your file, and if you have time, just look into several lines of that. I'm gonna take this time to find out if I have given you this data and some R code, okay, to upload the Blackboard. Okay, guys, so let's start my exhibition for this part. I think if you look at your Blackboard, let me show here. If you look at your Blackboard in the lecture 3, I have already uploaded most of the data sets for this semesters. And I think the MTB3MS and MTB6MS is the 2 interest rate time series we need. Okay, so you just basically download these 2 data files on your computer for this course, and you want to remember the past, you save them. Okay, so you can do this right now. And but I think I also re-upload at this current lectures also in the Blackboard, so you can download them, whatever, each of them. Okay, and meanwhile, I want to discuss a little bit things on the data, because today these 2 data sets has a little bit very special structures, and you want open your lab 1 files. The lab 1, I think we already have that. You just open this file, because I think we have I have several lines handling with 2 datas to tell you something novel stuffs. In the lab 1 I didn't mention. So I will move to today's. Okay. And now afterwards, we're going to today's implementation of the methods. Okay, so let's firstly, or I can go to this, right? Let's go to the TB3, right? TB3. Now let's look at this data. So this data is simply the TB, let me see, I forgot it, TB3, right? The TB3, that means the 3 years, the treasury bill rates, the treasury bond, right? Treasury bond. And this is the yields, all right? This look at the histories. 1934, we have data as far as 1934, and January 1st, we have a 0.72, the yields, right? And you can see how large it is. At that time, during the World War I and World War II, basically the treasury yields is very low. It's very low. It's probably due to history. Now, in what time is it bounced up? You can see after the World War II, right? After World War II, the economy began to bounce back. It's going to be 11016. So you can go through, right? 54, 1, 2. So it's increase, right? Increase, and then it goes to very high. If you probably can't think about for 1980s. 1980, we have experienced very exciting moments. I mean, crazy. At that time, the mortgage rates can be as far as 13%, 15%, right? So you can't imagine that the people buy a house in 1980s, they lock on their rates for such a high level. Definitely, they probably didn't want to refinancing at that time later on, but their yields is very high, right? It's simply because the expansionary economy since 1980s, right after the Bretton Woods system, when the dollar, this is a kind of interesting. You probably know some background on the international modern world, the currency system. So the dollar in the before 1970 and between the World War II and 1970s, we used the Bretton Woods system. Under the Bretton Woods system, the dollar and the gold is interrelated. Like I think these 1 ounce gold will equal to $35. The U.S. government has to make sure it's fixed. Then the other country can link their currency with dollar or link with the gold, and the system is good. However, because the Vietnam War, the U.S. dollar become to devalue because the Johnson government want to printing the money to save the dollars. Sorry for the fiscal deficiencies, right? So in this case, then dollar devalued after the breaking the rules with dollar and the gold, the fixed rates. So when the dollar devalued, then the money become kind of more unstabilized. So in the 1980s, right, at 1980s, when the U.S. economy engaged in the expansion after 1970s chaos, when they and also included the oil price in the oil crisis in 1980s in the Middle East. So the yields will go to hike up very high level. But later on in 1982, right? So when the Bush government take over and the Reagan government take over, it's slowly decreases a little bit, right? Which is what we call the crazy 1980 periods. So from the yields, you can find a little bit about the economy for the U.S. economy. But in recent years, if you look at the 2010, the yields goes to really lower, really lower, right? So this is the 3-year bond is very low. Okay. Now, what I want to emphasize here, you can see that this data file is a little bit special in the sense that they separate the calendar, like a year, there's number, a month, there's number, the day, there's numbers. Of course, this data has been cleaned by the author, but I want to say this is kind of a very good way if you're handling the data. The reason that most of the data we do before take some calendar date, right? For example, like 1934, January 1st, that's 01/01 1934, whatever the year. That sometimes cause problem. The reason is that on our studio, actually, and any other software where you look at the Python, look the Stata, look the SAS, when they handle the time series data, they have different requirements on the calendar time format. And you can't see by your naked eyes. They have their own requirements in their system. So sometimes, although it looks like the calendar is perfectly expressed like the calendar date, but actually it is not calendar date format. So computer will give you wrong information. So always it is a good habit that you want to decompose original calendar date, decompose that year, month, day, and each of them will be simply numerical numbers. Now, you will find that such a data is very clean. You will not worry about any special calendar date requirements or format, right, when you're coding them, because it's each represents each unit with just simply numerical number, right? It's okay, for example, if I'm a boss, I want you to find out the data for 1994. Okay, you just pin down the rows, the first column with 1934, that's it, right? If you want, okay, your boss want to say, can you help me take out all the 1934, sorry, that's not this for, can you take out every January data along the history? I only want January. I want to look into how the tax refunding relate to the yield's performance. Only January. You can see that's still very easy. You just simply want the data, the rows with the third column, month column with 0, 1, right? So in this case, when you decompose those numbers, you will find something easy to handle with data. So why we store in this format, okay? And let's take another look at, oh, sorry, this is not the 3 months, the 6 months is, right? 3 months, 6 months is, this is my bad, right? It's just different name, right? This the 6 months is, so 6 months is 1958, right? 58, month 12, day 1, the value, right? So you can see this is the ones, right? Okay, so wait a bit, I think I experienced some problem. Sorry about that. I think, yeah, that's my bad. I'm so sorry. I'm so sorry. I think I uploaded the wrong data because there's so many data there. I think the data they want us is this W/GS 1 year, GS 3 years. Let me try to find if I have them and I re-upload that. Okay, so but I still want to continue to finish my part on the lab 1 because there's several lines of data cleaning techniques I want to introduce to you. Okay, so wait for several minutes for me. Let me reorganize that. I want to let me see if I have the data. Let me download the original data we have here. Okay, perfect. Thank you very much. So the seems that the runner give us the data file. Okay, so
Yeah, I think they're from the same website. I just like control find, like control
yeah,
F.
sure, no problem. Let me do this for every guys and upload to the Blackboard. GS 1 year. Wait a minute, guys. I just download the data and save as TXT and re-upload to Blackboard, so you can do like download, or you can do by your own selves, right? Since we already have these, you know, the runner has provided for us this. Okay. So let me. Okay, GS 1 year. Perfect. Okay, so I think I have help us provide the data to the Blackboard, right? Under the lecture 6, you will find that this is a 1 year government rate and 2 years, right? If you look at the data again, so they're similar. So the author obviously again decompose the calendar to the year, numerical month, and numerical day. As we mentioned, that there's some very good usage for that. I will demonstrate with different data sets. Okay, I didn't talk in the lab 1 exercise. Okay, so before that, let's talk about some data cleaning techniques. Continue to use the data file, the TB 3 months is TB. This one is use the trend review. It's very similar because the exercise we talk about today use the 1 year and the 3 years trend rebound, because bond is longer term, right? The trend review is less than 1 year, usually the 3 months and the 6 months. Obviously, their rates will be lower, right? Because the short period. So the data will be 3 months and 6 months. We already have that, okay? And so let's go to, you can do slowly on your side. It's not hurry. I just simply open my lab 1 file. So this is my lab 1 file, right? I believe you already have that. I believe so, okay? And if you perform this, do what I told you this several weeks ago. And I'm looking into the exercise 3, this part, the line 57, my original code. Exercise 3. So this exercise basically to let you to handling with the data that the calendar date is stored as the year, months, and the day separated, and how to plot them, how to do some simple data organizations. All right, and okay, and this is always good habit to examine what this data looks like. Let's go back to the Blackboard. Okay, so I go to the, for example, the 3 months trend review. 3 months trend review is starting from 1934. Okay, you want to pay attention to that. However, if you look the 6 months trend review, it's starting from 1958. Okay, so that's the things. The 2 data file, they are not the same size. That's what you want to be careful with that. So when you analyze data anymore, you want to make sure the starting point of the 2 data sets, okay? And you want to check if at the ending date, if they're the same. The ending date for 6 months is 2010 February 1st, right? 2010 February 1st. And let's check this 3 months here. It's again same. 2010 February 1st. Okay, so we know the 2 data sets, the different starting point, but the same ending date. Okay, that's perfect. We have some idea on that. So what are we gonna do here? So it depends on your task, right? You want to firstly read the tables, right? Read the tables. That's the 2 things you want to start with. For example, I have read that, right? I have read that, and let me simply run this. Who knows? Maybe something wrong comes out, right? There are always stupid bugs come out. So let's try this. But I think before that, I need to tell the computer where the file saves, right? I want to do this, right? Again, so I need to tell the computer, okay, all of my files is saved under this, the course file, right? And tell that, okay? And install the fbasics, which is may or may not be used today, but just run that, okay? And so the next, let's go to the exercise 3 we're gonna talk about today, right? You want to read into the 2 data file, right? For the trend review, 3 months and the 6 months. Let's run this. Okay, it's obviously you have a successfully enter into that. Let's look at the X file. So X file, you have a year, month, day value, perfect, right? Right into that. And you have a Y, perfect, starting from 1958, year, month, day. And you want to be careful that they give you data X. Look at this. So they have a 914 observations of 4 variables, and the Y has 615 observations. This is a much shorter one because it's starting from later date, 1958. This is from 1934, right? Okay, so in this case, I'm not sure what I'm doing here because I just do the very simple kindergarten math, right? So I just look at the how much is the differences, right? 635. Wait, I'm not sure why to label that. Oh, okay. So what I'm doing here right now, because it's differences, right? Differences. I want to look in that. We know that X file, it's starting from very earlier, 1934. I just want to know in 1954, which is another, the earliest date of another file, which row is corresponding to. I just simply want to neglect the non-overlapping data, right? For example, in this case, 1934 to 1954, in this file Y, they don't have, they're missing the data. So I just simply neglect that, right? I'm just looking out, okay, which row is corresponding to, let's say Y. Y is corresponding 1958, right? You probably say, this is a very stupid way, but give you some good sense on the where's the data, right? Let's say 1958. It's here, right? It's here. It's kind of like here, right? 1958, right? So let's start 1958, December 1st. So in the X is corresponding to line 300, right? It's starting from 300 and then will merge with another data, right? It's kind of basic ideas, right? So, okay, so now in this case, I just look into the data, right, to find out if they're the same, right? Okay, they're exactly the same, 1958, December, and day one. So, okay, so we can starting from the same date, right? Okay, so now the next question is interesting. I want to plot the data. I want to plot the data. So the data, this is the value. However, there's a challenge. Although it's a good starting point that we decompose the calendar date by the numerical month, year, and day. But when I plot that, it's kind of a problem. The reason that how can we let computer to understand in this order? This is the kind of a calendar order. How can I let computer do that? I can, right? For example, I want to plot, how can I synthesize the three columns to some data point, let the computer know this is the calendar date, right? In terms of the order of that. So some people say you want to use the year. You definitely, you don't want to use the day. That's like a disaster because the day is always the same one. That means when you plot them on the x equals 1, you have a multiple data on the y-axis. It's this problematic. And even for the months, it's still the same thing. The months, it is, say, also repetitive, right? For example, the January, February, May, every year has that. So you will find that the data is very weird when you plot them. For May, there's multiple years, multiple data points. Some people may say, I want to use the year. I say even another disasters because you can see 1958, 1958, 1950, those are the same X, right? But you have a different Y. So let's give us some, the tricky part. So my way to do that, not necessarily the optimal way, but probably the most straightforward way. You just simply, let's first look into the next. I want to combine the two data because we want to analyze that data they combine together in the same file, right? So in this case, I want to construct a new data to combine with the 3 months and the 6 months starting from 1958, December 1st. So what we do is here, okay? For example, I run this. And then you will find int, right? It's like this, right? The int is here. So int here. So this is the two data files from 1958. There's two files, right, together. However, you will find that I didn't give the variable name. Okay, the variable name. So what happens here? You can see the int, the new matrix I established, they have two columns, 1 and 2. That's understandable because there's a 1 3 months is variable and the other is a 6 months is variable. And this is the observation points of 615, right? There's common overlapping dates. There's 615 observations. However, the structure of int, it is not a data frame. In our studio, like here, like this file, original X, this is a data frame because they have a variables, they have a year. It's kind of like a table, very formal way. However, the int file is not a formal data frame. It's just kind of like array, a collection of data that's say 2 columns, right? Why we say so? Because note that the command we use is cbind. Cbind is a very flexible command, which is combine any 2 arrays together, right? So for example, this, I combine the Y data first column, but because remember in each XY, the first 3 column is a year, month, day. I don't want that. I only want the value, the interest rate. So this is at the first column. And also for the X, which is 3 months interest rate, remember the purpose 300 rows, they don't have the data in the Y. So in this case, I just starting from the row numbers 300, right? Starting from 1958. So in the first column, right? So and I combine them together, I use a cbind. Okay, so this is the one things. Of course, if you're interested, I will say I want to convert this to a formal data frame, which is a variable name. You can do that. There's a simple command. You can search at Google, but here I just save time, right? So now I coin another dimensions for me to plot. We haven't mentioned that. There's a multiple year, the multiple months, multiple days, they're the same. You can't use that. So I just exemplify each date and day 1, day 2, day 3. Just reorder that, right? Reorder the date. So I just simply manually calculate, right? For example, here, both of the dates are from the 1959. 1959. Some people may be asking, you just starting from 1958, but don't worry. Let's look at what we have here. I starting from 1959. I just want looking to change the months and the date to the decimal points, right? For example, there is a 1 to 615 observations. So for example, like the first day is equals 1, right? It's 1. 1 plus 11 equals 12. And 12 divided by 12 equals 1, right? Plus that. And then I use the say equals 2. 2 plus 11 equals 13. 13 divided by 12 plus 1959. So what I'm doing here, I convert each date by some math games to change each unique name, the numbers, right? 1959, 1959.3, 1959.4, something like that, right? So maybe that's not optimal way, but in this way, we can differentiate each date, right? If you find that original data file, they're not follow the calendar date format, okay? So, so then you plot that, all right? And let me see what we have here. Okay, you do that. Okay, the max is kind of you find what is the maximum interest rate yield is 13.3 percentage, right? Now let's plot this. Right, so this is the plot we have, right? I plot this 3 months and 6 months. It's very similar to the year 1 and year 3, the treasury bond, right? The similar things, right? So you can plot that, and you can see I can plot the year here, right? That is a better way, because if your original data, right? Because for 1959, any year, you have a multiple months and day corresponding to the same year. You can't directly use the year column to plot. So I convert to the decimal points, right? Actually, the number is 1960, 1960.8, something like that, right? Okay, and you convert the year. So what I'm saying here, this data in the RStudio, it is not time series data. It is not a specific time series feature. It's just simply a numerical structure, just number and a number plot, that's it. Although I can label the name of the X like a year, but we know the inside the data structure is not a calendar date, right? Okay, and now let's plot here. The TDX is kind of an X, right? Here is kind of a y. Remember, the int is a new data file we established, right? Only include the 3 months and the 6 months interest rate in the first column and the second column, right? So x label, I use the label, the name, the type equals the line is a solid line, right? And the y limit represents the limitation of the y. Is kind of, because we know the maximum of the yield is 16.5, we have to check that, right? Use the max functions. So in this case, it's 0 between 0 and 16.5. So in this case, we can make the graph is more precision, right? Because you already know that R maybe, if you didn't specify that, might R maybe give you 20 or 30. You want highlight the magnitude of that, right? So you want to specify the maximum is a truly maximum of all the data. Okay, and now let's say what I have here. So this class I just want to spend some time to teach you some data wrangling, which is actually very common, in your daily lives. Probably handle this more frequently because nowadays we have so many software do the function very easily, right? So most of the time people do the data cleaning work. Okay, but remember the lines here. When we plot the 3 years months, we use the plot function. But when we use the plot the 6 months, I simply use the lines command. What's the difference between the two? We understand the plot, right? The plot is simply x and y in a formal figure. Lines is another function is good that if you want to plot more than 2 lines in the same graph, you want to use the lines. Some people may say, can I use the plot here? That's will be problem. Because if you give the 2 plots, usually the RStudio sometimes will be confusing. They might be only plot the first one. Okay, they treat them as a parallel command. They will do in order. However, if you put lines here, the RStudio is know that you want put the second line in a previous graph. Okay, so that's the kind of tricky, you better want to make some notes, because in that case you can save your time in the future. And let's say what we have here. And this one, I want look into the spread, right? For example, I want look into the 3 months and the 6 months spread. Usually this number represents the riskiness. How much the 6 months riskiness convert to the shorter term, like 3 months. I simply take the differences. This one is very easy. Okay, so sorry to run this. Okay, so let's look at the figures we have here. All right, and so this figure. So this is a kind of a spread. The higher the spread represents the riskiness, right? Usually you will find that usually the lowest, the deepest spreads will follow by the highest. This one is a negative, represents 3 months yields is lower than 3 months. It's normal. The reason is that we know the longer term the yield should be higher. It is lower because simply the people expect there's recessions. However, after recession, your economy will goes to upper bound, right? Jump. So it's like this, right? It's a fluctuate, and then you can see there's upper and lower bound is pretty steady. Okay. The eye line here, I just draw a horizontal line likes to zeros, right? It's 0. So in this case, can highlight the magnitude, right? We call them ebb lines, right? So I also give you some notes what the functions of ebb lines, what you want. You can add any horizontal lines here, right? Okay. Now the question is that some students may be asked, okay, so you plot this, you do some math tricks, but the question that I really want to plot in the time series structure or format in RStudio, what can I do? Now you can, but you need some more advanced RStudio functions. Let me do this right now. Okay, let's completely eliminate that. So this one, I need to install 3 packages: Lubricate, Tiddler, and Tidyverse. Sorry. Okay, no problem. So those 3 functions will help you to convert original data do some really complicated data wrangling or data manipulation work. We will see that. Okay, you first need to install your computer and call them. Let's firstly install them. It requires some time. Okay, now in the R environment, you will find some interesting. You don't need the right colored words. They're just some useless warning. And afterward, you will find something like this. I don't know if you have, for example, like attaching package conflicts. That means, and sometimes the mask something, because in our studio there we have so many packages, and some packages have functions overlapping with the other one. If you install all together, there's some overlappings or conflicts. So, but our studio will automatically select the one of them, right? You don't need to worry about them. So this is the has been installed, right? So again, so I successfully installed. So what we can do here, okay, what we can do here. Now, let's do this. So I firstly, so what's this function that I just do by myself? This one just simply represents that you have a Y and X file, right? For example, like X here, right? So you have a YX file. Now this is the last column. Remember, I changed the name. Previously, which is so-called value. Now I change to value /3m. I want to differentiate. Why I do so? Now in the next step, I want to merge these two data. The two data has the same column named the value. One is 3 months, the other is 6 months. But when you combine them together, what happens? Because they have the same name, the value, the final results will be really awkward, right? That means computer will have no idea why is the same value, the name, why you want to combine. Are they same or they different? So you better want to rename that. One is the value 3m, the other is the value 6m, right? And the command will be simply column names. You want to change the name of the first column, so you want to put a 4 here. This one is the new name you want to put into differentiate. Okay. Now you can take the merge. Merge X and Y all equals true. That means you want to merge all of the data. In the future, if you want to handle with more complex data, you will find that sometimes you want to merge only part of them. And sometimes you want to merge overlapping parts, right? Actually, we can do this in previous examples, right? So let's do this. We coin a new data file. Okay, we merge together. When we merge together, we have a 3 columns, sorry, the 2 columns. One is 3m value, the 6 months value, and the 3 months value. And then you will find that for 6 months value, there is a liking of the data. Why? Because we don't have originally. So the R will assign not available directly. So what I can do, I want to delete those rows, right? Those are actually not so hard. You just simply drop an A. So this represents the command. Well, drop that. Some people maybe ask, what does it mean for you want to rename the TB36M, which is the new name of the file we created previous line. You take this file, you take the TB, copy the name again, use the double percentage. What does it mean here? This is a special command in RStudio. The simply meaning that I want to work on the data file right now. I just established. So to let RStudio know that, you will know that, okay, I want to work on the file, name TB/3m6m. Okay, I want to work on that. How can I let computer know that I want to work all of the next step on this same file? I use the double percentage. It just simply means transition, transfer. Okay, the next step, I want to drop all of the items with not available. Okay, and after this work, right, definitely your data will be changed, right? So I want to all of the information change will receive to original. That means I don't want to change the file name. The name is still TB3M6M. You can change another name, right? Whatever. So let's do this. What happens here? And you can see, so in this case, the not available file has been deleted, right? So all of them are starting from 1958. So that's kind of a data wrangling way, how to handle in ways that the starting date is different. You want to merge and it will cancel out the not available data parts, right? Probably that's a better way. Okay, so this one is the very good habit. Sometimes the data has different class. If you look at RStudio, right? Look at RStudio. Sometimes the class of the number is numerical. That means just really number. Sometimes the class is a characteristic. For example, like number 4. Number 4 is look like a number, but sometimes it's not actually a number. It's actually a kind of a signal. Just name the 4. Right? It's not an Arabic number, not numerical number. It's just simply a symbol, right? Or sometimes, for example, 0 and 1. We know 0, 1 is numerical, but sometimes it's not. It is just represents a class, like female or male. I rename 0 or 1. It's not a number. It's just a characteristic. So in this case, the good habit is that you want to check if there's a data is a class. Sometimes the data file original, it is not numerical, right? You want to check that. So what I'm going to do is that this one is to give you some magic. Let's firstly run this, what's going to happen. Okay, so I establish a new file. Okay. You can see this is a new command. I put this. I put a th3m6m, sorry, $ time new with tb3m6m ymd paste year month day separate blank. So what is about? Let me introduce this is the magic command, which is probably the most important in RStudio, distinguished with other software. This function just simply means remember original name. Our original is a year, month, and date is separate numerical number. I really want to combine them three together to form a calendar date format. So in this case, I want to paste. That means I want to join these three numbers together, right? 1994, comma, May, comma, 10. Combine them together like a paste, right? And I use this separation is a blank, right? Comma, blank. YMD, I just say take the year, month, day, calendar format, YMD, and work on the file TB3M6M, right? And the with just simply means that work on this file and automatically save by itself, right? So which variable we're working on, I want to establish a new variable, new column to store the new number I generate. And this new variable is so-called time new. Let's look at the original data, what it looks like. See, in the next column, I establish a new one. And this new one, take the format 1958 space 12 space 01. Right, and this column is basically a combination of the first three. So what we can do, we can basically just drop the first three columns and leave this one. So your data become a more, looks like more, maybe, you know, looks more comfortably, right, this way, right? Okay. So the next step is very easy work. How to cancel out the first three column, which is useless? I simply use the same function. I still work on the same file, right? I use the double percentage sign. That means I work on this. Next step. Next, I want to select negative C123. That means I want this, the C means collection, a combination of the first, second, and three column, and then delete them. Delete them, I use negative, right? Negative, delete them. Select, that means I want to filter some conditions, right? So filter condition, I drop the first three column, and let's do this. Run this. Okay, let's see what happens. So sorry. I think I should not have this. There's some select the applied object. No. Oh, okay, my bad. Since you already changed your data structure TB3M to 6M, I think I need to rerun from the, the previously. So you can see we basically dropped the first three column and the last column available here, right? And note that there's a typo here. There's no more double percentage sign here. You want to delete that. The reason is that you have a no more task in the next. It's finished. So don't do this again. Okay. Or you can do this, do the major with the shorter ones. I just give you a note, right? So select this. It's just an easier expression, right? The best way to do the double percentage, that means you can do multiple tasks on the same file, right? This is one task, you probably want to cancel other data, you want to single out other type of data, you want to filter other, you can do multiple tasks on the same file. So you can use continuously use the double percentage signs there, right? Okay. I'm not sure you're still with me right now, but I hope so. I try my best slowly. And those files just, I think you just, go through each line. If you really cannot catch my, ideas, and you can, those can easily to Google, okay? And you run this, look at the final results, you will know, okay, what's the function it is, okay? And so, I just want to delete that. This is useless, lab 2 useless, lab 3 is not, again, not useful. Okay, so probably today I don't want to continue on the rerun the current examples, right? The 1 year, 3 years regression. I'm pretty sure you can do by your own self. Just copy the code. That's it. If any difficulty, you can figure out by your own self. It's a good exercise. If you can figure out your own bugs, I think that's a very important. As a programmer or either learners and the computer programming, you find a problem, a lot of red color warning, and you solve them. That's the very basic probabilities. The capabilities, right? That's very important. For me, if I'm not coding, you have some problem and you figure out by yourself. Sometimes very time consuming, but it's very fruitful in the future. Okay. Now let's look at, I just mention some key point here in today's class. All right. Let's go back to the class materials, right? So for example, the regression, right? You get those two data file. You just only want the first column, right? That's 1 year and 3 year, the yield, and then you simply do linear regression. Okay, that's a problem come out. Why I say so? I think I need to mention to you something interesting here. This is lecture 6. This is today's file, right? I just uploaded the first year and 3 years rate. Can anybody tell me, is this data file, is this a time series structure? Do you think it is a time series structure, or just simply number of rows of data? That's it.
I believe it would be a
Time series.
time series
You think
because it has the times, like year, month. That's year, month, and date, right? Day.
Yes, I know. We human know whatever the structure, we know it's a time series. We know it happens each day. However, when I type right into the RStudio, we have 4 columns. The first column is year, right? Do you think it's a time series data? In the RStudio environment, if you don't do any handling, processing, you can. Remember the example I just did for the 3 months, 6 months data. I do some work on the converting, a lot of a calendar time. That work is kind of let the computer know I'm working on the time series data. But in reality, when you type into this data, because those are not calendar format, it's not recognized. It will not be recognized in our studio environment. Okay, computer will not know it is time series. Computer only know, okay, you have a 4 columns. Each column have a 4 decimal point, 4 digital number. Second column have a 2 digital number. Third column has a 2 digital number, and the last first column has 2 decimals, 3.20. That's it, just 4 column number. You need to let our studio tell them, okay, this is time series, but this is another command lines. I will introduce later on, which is so-called TS, right? Tell the computer it's time series. That's it. Okay. However, that's the tricky part in this regression. The reason is that, remember, we are looking into regression. That means X and the Y. We basically neglect the time series effects. That is actually good for us. Why we do this? Because we simply look into, okay, the Y is 3 years data, X is 1 year data, right? The 2 column, that's it. We don't care about it is a time series or not. So you may want to ask, what is the impacts after we recognize it is time series or not? Because if it were time series, we need to think about like autocorrelations or long time series, right? We need to generate like ACF, autocorrelation. So now we don't think about its time series, we just think about there's a number of observations points, data points, that's it. I don't care about it is observed from any day. Okay, so this is very important techniques, and actually is a very simple treatment for the regression on the 2 time series data. Now, for this work, we'll do simple linear regression as we did in the undergraduate statistics class. No time series, that's it. Okay, so that's why we use the linear regression, LM, in the R studio. And this is the R1. I use the 1 year data as X to explain the 3 years data. Okay, I want to use the shorter term yield if it can be explained the longer term yield. And the summary results here, right? If you run this is coefficients, right? The intercept constant. This is the coefficients with R1. And you can see the p-value, significant. Okay, sounds like good news. It looks like the 1 year yield can explain the 3 year term structure of the interest yield. However, it's not the end of the story. The reason is that when you plot that, sorry, it's not show graph. When you plot that, remember you can go back. I will not scroll back on my side. You can do your side. The ACF is what? It's decaying very slow. That means it is non-stationary data, right? You need to make the ACF quickly goes to zeros or insignificant, right? So in this case, what you can do, take the first differences, make them stationary, right? So what the next, so they just basically plot ACF. You will find that, right? It's very decaying, very slow. So what the next step they can do, they do take the difference, DIFF, right? DIFF represents take the first order differences and you rerun the regression. Okay, so -1 here means that I don't want constant items, the intercept. I don't want, you tell the R, I don't want this. Okay, and then you can summarize the information and they give you this. So there are no constant. There are only coefficients associated with the C1, the first difference of the 1 year yields. And this is also significant. Okay, this is also significant. However, the good news is that when you check the ACF right now, the residue looks like a decaying very quickly. That means it is a stationary data or approximately, right? Okay, so the last model, if you remember, the author is not satisfied with the first difference. They also want to model the residuals as some function of the past information shocks, right? So in this case, what they can do, they combine them together. They call them ARIMA. They use the order because remember, they want to model the residuals at the moving average because they found the ACF, the leg 1 is most significant. So when they cut off at order 1 at the moving average, right? And then they took the regression. And ARIMA has a very good command and a very good function. The computer knows that you want to model the residual and simultaneously want regression C1 and C3. So they will put X rag here. So they will know you have a second equation which is one linear regression, C1 and C3. And then simultaneously you want to model the residuals as a moving average, right? Combine them together, right? Include dot mean is represents, I don't want the constant terms in the moving average, right? Then they give you simple data, right? So okay, so this is the this is kind of a summary, right? When we do our work, we just simply stepwisely check which model is good for us. I want to check the R square. I want to check most important the ACF of the residuals. If you look, the arrows is random, right? Actually, the more random, the better. The more linear, the more serial correlations, there's more problems on your models, right? That means your data is not stationary. If the data is not stationary, you can't use the MA or AR models, if you remember that. Okay, so that's all. I think that's for today's class. We have introduced the mini case we discussed. It's kind of a combined with the regression time series, and we also teach you some of the RStudio and data wrangling techniques. I hope you spend the time to go over them. Right, all of them have a solutions. So meanwhile, if you have any questions on assignment 1, just let me know. Okay, we'll see you next week. Have a good night.
Next week, excuse
Have a
me.
good night.
Thank you.
Next week is midterm or the week after?
Sorry, can
On
you say it again?
24th? I said the midterm on 24th.
Okay, perfect. That's a good question. You don't worry about it. I will give you the entire week to work on the assignment. I don't want to prepare to give them your like 1 day limit or several hours limit each.
Okay.
I will give you like assignment, just kind of a second assignment. Think about like that way.
Okay, and the next week is gonna be a regular class, right?
Yeah.
Okay, thank you.
Okay. If any no questions, you can leave the room. Thank you.
Have a good night, Professor.
You too. Bye bye. Thank you very much. Thank you very much, guys.
Professor, I had
Yeah.
a question. I know I emailed you about it, but it was for the first problem. I don't know if you went over in like the very first few minutes of class because I entered like 10 minutes late.
Wait.
Because I saw you went over.
Sorry, you talked about so quickly. What's your problem?
That's okay. For the assignment that we were assigned, I know I got the code right. I just wanted to know if you went over question 1, where it asked about the daily and weekly log returned, I think the problem was.
Oh,
So I don't know if you went over it because I came in like 10 minutes late to the class.
no.
Um,
I didn't talk about too much detail because I upload the solutions. Do you see that?
I didn't get a chance to see it,
Okay.
but did it include just the code? Because the
No,
version that you
the assignment
on.
solutions include everything, explanation and the code, everything. The question 1,
okay.
question 2. Yeah, good. If you have any problem, you can email me or we can discuss next class.
Okay, sounds good. I'll take a look. Thank you.
Thank you. No problem. Bye.